So we've been in a 10-year steady market. There's been no real bear market. We were in a steady market, then a 10-year bull market, and then a steady market for about 9 years now, from 2016 until now. And we're going to head to another bull market in gold relative to commodities very soon, if we haven't even started already. And silver is going to show you a similar chart, but a little bit more wobbly, obviously. But in the end game, silver is going to out gold, moving to new highs, and new highs is not attracting the retail crowd, not in ETFs, not in other paper funds. This is still a banker war or a family office war. I don't know if central banks are involved in it or if options trading. Some rumors are options trading and like gamma or delta hedging. I don't even know what that really is so much. Chris probably knows more about that than I do. But it's a banker war that's going on right now. It's not in the retail market yet, and Costco may change that, but we'll see. I wanted to put this chart out there. This is gold relative to the CRB, which I've shown before, but from a slightly different perspective. So I want to show you a long-term perspective from 1990 here. So 1990 to about 2006, gold relative to other commodities, gold's real purchasing power relative to other commodities.
For the past decade, the market has been pretty stable, with a long bull run lasting for about 10 years. Now it seems like there's another bull market on the horizon, especially for gold and other commodities. Gold prices have been climbing steadily, hitting record highs recently, but strangely, regular folks aren't jumping into the gold market much. Instead, it seems like there's some kind of behind-the-scenes struggle happening, maybe between big banks or wealthy families. This could be why the regular retail crowd isn't getting into gold investments like ETFs. Rafi Farber, finance expert, explains that gold's purchasing power compared to other goods has been pretty stable for a while, but around 2006 it started to shoot up, signaling the start of a bull market. He also talks about a similar trend with silver. So, while gold prices are soaring, it seems like something bigger is going on in the financial world, possibly involving big players like banks and family offices. Rafi suggests it might be like a banker war or a clash among wealthy families. It's not clear yet what's causing this, but it's definitely worth keeping an eye on.
Now, if it ended in 2016 and we're still at that same ratio, I would just blame it on the lockdowns. And, lockdowns are going to bring commodity prices very, very low because you don't use commodities when you can't leave your house. And then gold was gaining value relative to other commodities because we were in a monetary crisis. But if we just iron this out for a minute as some kind of insane spike from some crazy policy, then gold has been steady relative to other commodities since 2016. So we've been in a 10-year steady market. There's been no real bear market. We were in a steady market, then a 10-year bull market, and then a steady market for about 9 years now, from 2016 until now. And we're going to head to another bull market in gold relative to commodities very soon, if we haven't even started already. This perspective also long-term, just to give you an idea of where we are historically. So commodities never really recover. This is the same chart inverted, I think. So gold relative to other commodities in 1980, and I put a tiny little line here, a very thin line, so you can see. So this is the 1980 top in gold relative to commodities. So the CRB relative to gold was at an all-time low, meaning gold was at an all-time high relative to commodities in 1980. And look at that, we're pretty much at the same level. So commodities have never recovered that well. I mean, they kind of recovered here in 2000. Yeah, so let's say 0.9 from about 0.4. So yeah, it doubled. They did recover a little bit, but we're back down to 1980 levels since around 2010. In gold relative to commodities, and also silver. And silver is going to show you a similar chart, but a little bit more wobbly, obviously. But in the end game, silver is going to outpace gold, as it always does towards the end of rallies. So we see here a very stable silver price relative to other commodities for the same time frame, 1990 to 2006. And then a bull market that lasted until 2011. And then we'll find we can call this a bear market. And then we've been steady from about 2013 to now. So for about 10, 11.
Rafi Farber explains that despite some ups and downs, the market has been pretty steady for about a decade now. He sees a pattern where gold and silver prices have stayed relatively stable compared to other goods for several years, then shot up for a while and now seem to be stabilizing again. He believes we might be entering another period of rising prices for gold compared to other goods soon. He also points out that inflation, or the increase in prices over time, has been picking up speed lately. For example, the Consumer Price Index (CPI), which measures inflation, rose by 3.5% in March compared to the previous year. Some people, like Federal Reserve Governor Michelle Bowman, think we might need to raise interest rates to slow down inflation. However, others aren't so sure and think we might even need to cut rates instead. Rafi Farber and other experts are keeping a close eye on inflation, especially something called super core inflation, which excludes food and energy prices. It's currently at 5%, which is pretty high, and the rate of inflation over the past 3 months has been even higher, reaching 8%. These numbers are worrying because they could have big effects on the economy worldwide.
Super core inflation, super core is now running at 5%, whatever that, I don't know what super core inflation, it sounds really awesome though. While the 3-month changes jumped to 8%, not far from its early 2022 peak, which was then a 40-year high. So yeah, super core, I guess you could call that sticky or something like that, or something close to it. It's headed higher. And this is Apollo Global Management sounding the warning on inflation. Now here, Jared Bluke writes, the Fed aims to avoid repeating the double inflation episode that rocked the 1970s and early 1980s. That was that inflection point that I noted on the sticky price inflation chart that I just showed you. We're around there, 1977, 1978, could be 1979, depends exactly. Nothing is exact. Here he writes, after price inflation spiked to 12% in 1974, the Arthur Burns-led Fed was quick to keep the policy rate relatively low, even as inflation rose again. So the policy rate is still relatively low because real interest rates are still very, very low, even though they're positive. Positive doesn't mean high. He writes about Volcker, and this I didn't realize about Volcker. In 1979, after price inflation poked above 10% again, Paul Volcker, notice how he uses the term price inflation, Jared Brooklyn, and not inflation. You see how he's sympathetic to the Austrian school, and he's trying to keep his definitions relatively straight. I commend him for that. Paul Volcker was installed as Fed chair to put the inflation genie back in the bottle for good. But even Volcker got it wrong. This is key. In these early days as Fed chair, less than a year into his 8-year tenure, the Fed funds rate stood north of 20% as CPI peaked at 15%. The Volcker Fed quickly lowered the policy rate to 9% over a few months, only to throttle it to 20% in 1980. From there, the Fed dropped it to 16%. The central bank was again forced to raise the benchmark to 20%, the third time in just over a year. So Volcker raised rates 3 times to 20%, and only the third time did the price inflation statistics get knocked down for long enough that he was safe in cutting rates. But the thing is, there's no way, no possible way, even if Volcker was chairman now, there'd be no possible way for him to do anything, because raising rates to anything close to that will bankrupt the entire planet. Because the entire planet is based on the dollar. And the dollar is 93% backed by treasuries and mortgage-backed securities. So raise rates and the dollar goes down. We'll get to that in the last slide, but let's continue with these slides. Now, people have been asking me, is it a good time to get into the minors? Am I chasing price? Is it too risky? Look, you could be chasing price, but is that really such a bad thing relatively? I mean, that depends on your financial situation. I'm not giving any advice to anybody, but I'm just showing you that mining stocks, including our sponsor, Fortuna Silver Mines, which we will get to in a minute, they are still incredibly low priced relative to the price of gold here. We see that this is the Huey to spot.
Rafi Farber discusses inflation, particularly a measure called super core inflation, which excludes food and energy prices. He explains that super core inflation is currently running at 5%, which is quite high, and the rate of inflation over the past 3 months has reached 8%. This is concerning because it's close to the peak seen in early 2022, which was the highest in 40 years. Rafi mentions how the Federal Reserve, or the Fed, is aiming to avoid a situation like the inflation spikes seen in the 1970s and early 1980s. He talks about Paul A. Volcker, who was the Fed chairman during that time, and how he raised interest rates significantly to combat inflation. However, Rafi believes that such drastic measures wouldn't be feasible today because the global economy relies heavily on the US dollar. Raising rates too high could cause major economic problems worldwide. Regarding investing in mining stocks, Rafi suggests that despite some risks, they are still relatively undervalued compared to the price of gold. He predicts that as gold prices continue to rise, mining stocks will likely see significant gains, similar to what happened in the early 2000s. He emphasizes the importance of doing thorough research and considering individual financial situations before making investment decisions. In conclusion, Rafi predicts that gold will remain a favored investment choice, especially during times of economic uncertainty and geopolitical tension. If you want to stay ahead of the curve and dive deeper into gold's potential, hit that subscribe button and smash the notification bell so you never miss an upload. Also, leave a comment below and let me know your thoughts on the gold market.